In this section, we are going to discuss how to scale out of trades, which is a great way to reduce your risk as you are exiting your trade, whether it's a winning or a losing trade. Let's dive into an example to explain how this is done. Here we have the Euro USD pair, let's say. And let's say that you want to go short or sell at the current price of 1.2000. Now that you've determined a good place to put your stop loss, you also decide that you don't want to risk more than 1% of your account on this trade. So let's say you have $10,000 in your account, so $100 would be 1% of your account. You calculate a lot size of 0.1 with the stop loss of 100 pips that would be risking 1% of your account. Now everything is set up and you wait for the market to move. A couple days later, the Euro USD has moved to 1.9000 or 100 pips in your favor. That means up until this point, you are $100 in floating profit or you've gained 1% of your account, which is awesome. Then a news event is released that makes you think that maybe the USD is going to weaken temporarily. And you think, this might push the Euro USD up instead of down, and so I should probably lock in some profits. So what you decide to do is you close half of your position. How do you do that? Well, you simply close your original trade and open a new trade at the current price right here of 1.900 with half the lot size or 0.05. What this does is it locks in $50. Since you closed $100 in profit right here with your original trade, and now you have a new open trade with half the lot size, and you've moved your stop loss to right here, just 100 pips away, the most you could possibly lose on that trade is $50. So with the $100 that you've closed in profit and the $50 as the max risk on your current new open trade, you've locked in at least a net profit of $50 on your original trade. Obviously, the risk to this is you could lock in $100 in profit if you just closed out of everything. But this also gives you a chance to make more if the market keeps moving down. And there's no way you could lose overall with this trade, even if it moves against you. Pretty cool, huh? So now we're sitting at this 1.900 price point with our new 0.05 lot size trade. Let's say that from there, the Euro USD ended up falling all the way down to the price of 1.1700. What does that mean for you? Well, first of all, it means that if you had stayed in your original trade from the very beginning up here at the 0.1 lot size, you would have made a total of 300 pips on that trade, which would have been a profit of $300. But since right here, after 100 pips, you closed $100 in profit and you opened a new trade at half of the lot size, 0.05, you made 100 pips at a 0.1 lot size and 200 pips at a 0.05 lot size. So you made $100 on this movement and $100 actually on the second movement, even though it was twice as big as the first movement. So by scaling out here, you just made $200 when your max profit could have been $300. The decision to take some profit off the table is always up to you. You just have to weigh the pros and the cons. Which is better for you? Making the $200 but being able to sleep at night because you have profit secured? Or risking losing money even when you're in floating profit, but with the chance to make a little more? It's completely up to you and what you prefer. Remember, the market could also move well past your target profit, and you could take advantage of this with a trailing stop instead of just having a take profit down here. In the next section, we're going to talk about scaling into trades. This is going to help you to maximize your profit the correct way.
Hey, thanks so much for watching. Make sure you join our free Discord channel to get access to all the cheat sheets and a bunch of other cool bonuses. The next video in the course is right here.